Welcome, clients and friends and partners of MBP Sterling Partners. I've got Matteo and Rob joining us. These have been some crazy markets these days, so we thought it best to have a little bit of a discussion of what's going on in the markets, politically or otherwise, and what we are doing as portfolio managers and stewards of your wealth to help us get through these times. So, Rob, I'll start with you. We've got some pretty, I'll call them crazy policy changes happening in the U.S. What's your take on what's going on with Trump and tariffs and the markets overall?
I reserve the right to change my mind at any time because the policy seems to change at any time. So as portfolio managers, it's a difficult environment to work in. We have worked in difficult environments before, and Matteo's going to talk a little bit more about that. But having said that, we know how to deal with these types of environments. And, a lot of times when you look at events like we have right now, geopolitical upheavals, and we've seen many over the course of my career, it's very easy to say, I just want to get out of the stock market. This is going to get worse. And my experience has been that people who want to pull the plug and get out think that they're anticipating what is about to happen next. Anticipating, for example, that there's going to be more tariff uncertainty or whatever it happens to be. In fact, in most cases, what they're doing is reacting to what has already happened. And so to then pull the plug and say, well, I'm going to get out. In a lot of cases, you're getting out after the worst has happened. You may think you're 25% into it when really you're 75% into it. And to get out means you have to do three things in a row correctly. And my clients have heard me talk about this before. You have to get out, you have to stay out, and you have to get back in. And those are, I think in life, it's difficult to do three things in a row correctly. Those things in the stock market are extremely difficult. Getting out is easy. Staying out, yeah. Getting back in is extremely difficult because the market does not react to the news of the day. Quite often, the market is reacting to what is going to happen 6 or 9 or 12 months out. And so, for example, after the financial collapse of 08-09, the stock market started reacting and going back up a good year before the economic signs improved. So once people do get out, I think they want to wait until things get better, but at that point, the stock market has already started back up. The Globe and Mail never runs a headline saying it's time to get back in. And so it has been our experience that the best way to handle it and the most successful clients that we have ever had are clients who stay in for the long haul, don't time the markets, and let the portfolio manager adjust the portfolios to the circumstances.
Yeah, and the damage of being out of the market for long periods of time is much harder to quantify. Because it just, inflation creeps away and takes little bites at a time until all of a sudden you're way behind the ball.
Yeah, it's just not proven to be a good strategy. Whereas we do know that that staying invested is the right strategy. And yes, this is a difficult time. They're all difficult. People will say, well, this is different this time. Well, they're always different, but they always end up the same, with economies growing, populations growing, GDP growing, money supply growing, and companies growing their business over time. And the best way to deal with that is to be fully invested.
What are we doing in the portfolio now in the current environment?
Clients will have noticed we've increased the number of positions in our portfolio, and that allows for broader diversification, less volatility as we move into this period of time. The cash that we have has been slower to be deployed, so we're being more thoughtful in terms of the types of companies that we're looking at. I guess the introductory weights that we add in terms of new names tend to be smaller, and then will increase over time as we see positive news and positive earnings come out from the company. So those are all changes that I'm going to say have occurred over the last little while, not specifically to the geopolitical event we're in now. I think the most important one is that whether it's Canada or the US, we have intentionally looked for new names where their revenue geographically is very country specific. And what I mean by that is, I'll take the US as an example. Three of the last three names that we've added, a financial, a consumer discretionary, a healthcare stock, all three, 100% of their revenues were from the US geographically. So to us, I think that sort of works to the theme that Mr. Trump is trying to drum up out there is, made in America, right? So if it's going to be made in America, then we're going to look for revenues and earnings that are made in America. And that's intentional. That's what we've done. Prior to that, we were still looking for earnings and revenue growth because we know that that's sort of the foundation of what we do. But I think the change that Rob and I have discussed and put in place is we want to have that much more revenue, whether it's Canada or the US, be very country specific. And I think it works to, what Mr. Trump is trying to put out there in terms of his policies. I think, I read a great headline this morning coming in. The only certainty is that there will be more uncertainty as we sort of roll out through this, geopolitical environment that we're in. And as Rob said, this is not new. We've seen this happen with the, going back to the oil embargo in 72, the China-US trade tariffs in 2018, the aluminum tariffs they put on in 2018 and 19. We've worked through all of those. Well, not 72 for me. I was still young back then. But the other two for sure. And what we've found time and time again is that we've seen this before. What's important is that we have a process in place. We have a discipline that speaks to how we buy and sell stocks. And that discipline, the specific way we manage money, gets rewarded over time. And that's the result of being disciplined is the reward that you get over time.
That's great. Rob, I'll shoot back to you. I mean, we say we've seen this before, but again, like the circumstances of everyone are a little bit different. I would point out that companies have high incentive to look at the current set of circumstances and figure it out and try to make money.
I don't think companies will react the way that the Trump government wants them to react. The Trump government wants them to react by building factories in the U.S., for example, creating more domestic manufacturing. The truth of the matter is companies cannot do that. Companies, for a company to announce that they are going to now build a factory in Pennsylvania is a 4, 8, 10, 12-year commitment. And the government could change during that period of time. And so we're not going to react by buying shares in a company that says they're going to do that. Because the truth of the matter is it's extremely difficult for companies to just turn manufacturing on a dime. So that's something we keep in mind.
Look, if this trade tariff continues to erode business confidence, or if investment begins to suffer, we both believe either the Fed or the Bank of Canada will step in and help out businesses. To what extent that happens, we don't know, because we don't know what and how long this prolonged tariff war is going to last.
Right. I agree. And I'd actually throw that and cast a wider net and say, in previous downturns, most of them have been caused by what we would call external events. Now, COVID is the obvious example of that. It couldn't be a more external event.
Right.
But even if we go back to the Great Recession in 2008, where over-leveraged households were the cause, or we go back to the tech bubble and bust of 2000, where we saw just a little bit of over-enthusiasm in a very specific sector cause what ended up being a mild recession, but it was bad for the markets nonetheless. There's always been a counterbalance from policymakers in most cases, monetary policymakers in the form of lower rates or more liquidity. And we've already heard from several of those central bankers that that is indeed going to be the case. Now, what I would argue that may actually be different this time is, this is an event being caused by the fiscal policymakers. So how much clout will the monetary policymakers have to counterbalance that?
Yeah, I would agree with you on that, but let's take a step back and change gears for a bit, and I think of the environment that we're in. So we just finished the fourth quarter earnings season. I believe the number was 16.9% quarterly earnings growth, which is a fantastic number. The next four quarters, I believe, are about 8.9, 11.5, 12.5, and I think close to 13. That is a fantastic, solid earnings environment. Now, your argument to me is going to be, yeah, but there's tariffs and estimates are coming down or expectations for earnings. Yeah, but I looked this morning and the rate of change over the last 3 months on expectations as of yesterday was minus 1%. Okay, I'll give you the 1%. And behind that, we still have double-digit earnings growth expected for the next 3 or 4 quarters. That's a very good environment. And people forget that, they forget that that's the environment that we're in today and expect it to be in. And again, we don't know how the tariffs are going to, impact the supply chains and ultimately the companies. But I got to believe where we're coming from is a pretty solid base today. And that's the environment Rob and I are working in.
And if I could add to that, the last number I saw for earnings expectations for this year was S&P earnings growth of 12% expected for 2025. So even if it is tempered by 1% or 2%, it's not minus. It's still a growing earnings economy. And I wonder if we could just go back and touch on one thing again, which is process. Matteo, you spoke about it. The way we have been successful for as many years as we've been successful is the constant exercise of process. And process involves looking at our portfolios. We look at them different than clients look at them, I think. We look at our portfolios almost as a single stock sometimes and say, what's the price earnings ratio of this stock? What's the expected growth rate of this stock? And we can calculate all a multitude of numbers to analyze our portfolio as if it was one stock in the weighting that each stock has in it. And we check this constantly. And I'm going to ask Matteo to just talk about the attribute summaries that we use and check to and give us a broad idea of what the portfolios look like right now.
Yeah, why not? That's a great lead in. I mean, look, we know that the market in general is trading at about 22, 23 times. The ROE is about 22%. This is for the S&P 500 weighted in terms of the names in the market. Our portfolio, weighted by our weights, as Rob says, we're trading at about 18 times earnings, so less than the S&P, and our ROE is 26%, significantly more than the S&P. But more importantly, and behind that is the gas that's feeding that ROE, which is earnings growth. So the market is, call it 4% earnings growth. Our portfolio is at 11% earnings growth. That's significantly ahead of where the market is, and that tells us that we have a lot of confidence that there's a lot of gas in that gas tank to keep things moving along. And remember, we've paid a lot less than the market. Whether you look at PE, price to sales, price to cash flow, across all the metrics. When we look at our portfolio as a whole, we're paying less, we're getting better profitability and stronger earnings growth. That's a good combination in my mind.
And stronger balance sheets.
And stronger balance sheets. Cleaner balance sheets, absolutely.
Right, and in the long term, those fundamentals are going to be what matters, regardless of what the policy of the day. I should probably say with these current policies of the hour, because who knows what's going to happen by the time you listen to this.
Yeah, and I focused on the U.S. Valuations. Canada is very similar. It's just a little more muted, both in terms of valuation and earnings growth, but very similar in terms of the setup and how we look at it.
Why don't we leave it there unless you guys have any final words of wisdom as we navigate through some choppier markets than we've been used to for the past couple of years?
The only thing I would say is what I've said. We've seen it before. We know how to deal with it, and we know what works.
That's great. And Rob, I love your framing of it in three different decisions as opposed to one. We're not deciding just to get out. We're deciding when, how long, and when to get back in. And I can guarantee you that last decision is the hardest of the three.
For sure.
Most definitely. It's counterintuitive to everything we think about, but you have to ignore it.
Yeah. Okay. Well, guys, thank you very much for taking the time to do this, and we look forward to our next discussion.
Thank you.